I've been investing for 75 years, and I've learned that the market goes through cycles where different sectors lead and lag. Sometimes technology dominates, sometimes energy leads, sometimes it's financials or consumer stocks. Most investors try to jump from sector to sector, chasing whatever's hot, trying to catch the next wave. And most of them fail because by the time a sector becomes obviously attractive, it's already overpriced. The real money is made by identifying which sectors will be essential, profitable, and reasonably valued over the next several years, and then having the patience to hold through the noise. Today, I'm going to tell you something I rarely do. I'm going to narrow down the entire investment universe to just 3 sectors, the only 3 sectors where I'm willing to deploy significant capital through 2027. Not because other sectors won't have good companies, but because these 3 offer the best combination of necessity, profitability, and reasonable valuations given what I see coming in the economy. If you understand why I'm focusing on these sectors and ignore almost everything else, you'll be positioned better than 90% of investors over the next 3 years. Let me start by explaining my framework for thinking about sectors, because this is crucial to understanding why I've narrowed my focus so dramatically. When I evaluate a sector, I ask several questions. First, is this sector providing goods or services that people and businesses absolutely need, not want, but need, regardless of economic conditions? Second, does this sector have structural advantages that allow companies to earn attractive returns on capital? Third, are valuations in this sector reasonable relative to historical norms and future earnings potential? Fourth, what are the major risks facing this sector, and are they manageable or catastrophic? And fifth, what's the likely regulatory and political environment for this sector over the next few years? Most sectors fail one or more of these tests right now. Technology is providing valuable services, but valuations are extreme in many areas. Magnificent 7 stocks are trading at 30, 40, 50 times earnings based on assumptions that growth will continue forever. I don't buy forever stories. Consumer discretionary is vulnerable because consumer balance sheets are stretched, savings are depleted, and we're likely facing economic slowdown. Real estate, especially commercial real estate, is facing a crisis from remote work, high interest rates, and over-leveraged properties. Healthcare is always somewhat attractive, but political risks around drug pricing and insurance reimbursement are significant. Financials are interesting in some ways, but regional banks are sitting on huge unrealized losses and face commercial real estate exposure. When I filter the entire market through my framework, only 3 sectors pass all the tests decisively. These are the sectors where I'm willing to bet significant capital, where I believe companies can generate solid returns regardless of economic conditions, where valuations are reasonable, and where the risks are manageable. The 3 sectors are energy, utilities, and consumer staples. Now, I know what you're thinking. Warren, those are boring old economy sectors. Where's the excitement? Where's the growth? And my answer is, I don't care about excitement. I care about making money and not losing money. These 3 sectors give me the highest probability of achieving both goals through 2027. Let me start with energy, because this is the sector where I've been most active and where I see the most misunderstanding from other investors. The conventional wisdom says energy is a dying industry, that renewable energy and electric vehicles are going to destroy demand for oil and gas, that investing in fossil fuels is betting against the future. This narrative has become so dominant that most institutional investors are underweighted in energy. Many are divesting entirely. And energy stocks trade at valuations that assume demand will collapse. But the conventional wisdom is wrong, badly wrong. And the investors who understand why are going to make a lot of money. Here are the facts that matter. Global oil demand is not declining. It's still growing. We consumed about 100 million barrels per day in 2019. After the COVID dip, we're back above 100 million barrels per day and growing. The International Energy Agency projects demand will continue growing through at least 2030, maybe longer. Yes, electric vehicles are growing, but they're still a small percentage of the global fleet. And aviation, shipping, petrochemicals, and plastics all require oil, and none have viable alternatives at scale. The energy transition is real, but it's going to take decades, not years. Meanwhile, The oil industry has dramatically underinvested in new production. During the 2010s, when oil prices crashed and environmental pressure intensified, oil companies slashed capital expenditure on new projects. Major oil companies reduced exploration budgets by 50 to 70% from their peaks. It takes 5 to 10 years to bring new oil projects online. The underinvestment from 2015 to 2020 means we're facing a structural supply deficit starting around 2025 through 2030. Demand is growing, supply growth is constrained, and that equation produces higher prices. But here's what makes energy particularly attractive right now. Energy companies learn painful lessons from the boom-bust cycles of the past. They're not reinvesting aggressively when prices rise. They're maintaining capital discipline, keeping production relatively flat, and returning huge amounts of cash to shareholders through dividends and buybacks. The major oil companies are generating free cash flow yields of 10 to 15% at current oil prices. That's extraordinary. And they're paying dividends of 4 to 6% with room to grow. If oil prices stay in the $70 to $90 range, which I think is likely, these companies are going to print money. At Berkshire, we've taken significant positions in Occidental Petroleum and Chevron. Occidental is particularly interesting because they have low-cost production in the Permian Basin, the most productive oil field in North America, and they're paying down debt rapidly while also returning cash to shareholders. Chevron is a high-quality integrated major with upstream production, downstream refining, and chemicals. They generate cash across the cycle and have one of the strongest balance sheets in the industry. I've also been looking at other energy names. ConocoPhillips has excellent assets and is purely upstream, so they benefit most when oil prices rise. EOG Resources is another high-quality producer with low-cost assets. But it's not just the oil majors. Energy infrastructure is equally attractive. Pipelines, storage facilities, export terminals. These assets generate steady cash flows under long-term contracts. They're like toll roads for energy. Companies like Enterprise Products Partners and Energy Transfer operate massive midstream networks. They charge fees to transport oil and gas regardless of the commodity price. Their cash flows are stable and predictable, and they pay large dividends. For investors who want energy exposure without commodity price risk, these infrastructure companies are ideal. The second sector I'm focusing on is utilities. And this might surprise people because utilities are usually considered the most boring investments possible. But boring is good when the world is uncertain, when valuations are stretched, and when you need reliable income. Utilities provide an essential service, electricity and natural gas, that people and businesses need regardless of economic conditions. Demand is extremely stable, and utilities are regulated monopolies. They don't face competition. They're allowed to earn regulated returns on their capital investments. This creates a unique economic model. Here's how utilities work. They invest capital in power plants, transmission lines, distribution networks, all the infrastructure needed to deliver electricity. Regulators allow them to earn a return on that invested capital, typically around 9 to 11%. As long as the utility makes prudent investments and operates efficiently, they're virtually guaranteed that return. This means utilities are one of the few businesses where you can predict cash flows and earnings with high confidence years into the future. And because they operate as monopolies in their service territories, they don't face the competitive pressures that erode returns in most industries. The energy transition actually benefits utilities. As the economy electrifies, as more vehicles go electric, as more heating systems switch from gas to electric, as data centers proliferate for AI and cloud computing, electricity demand is going to grow significantly for the first time in decades. Utilities will need to invest hundreds of billions in new generation capacity, transmission lines, and grid upgrades. All of that investment becomes part of their rate base on which they earn regulated returns. It's a growth story, but a safe, regulated growth story. Berkshire owns Berkshire Hathaway Energy, which includes major utility operations in the Western United States and the UK. We've invested over $100 billion in energy infrastructure through this subsidiary, and it generates several billion in earnings annually. But I'm also interested in publicly traded utilities. Companies like NextEra Energy, which is the largest producer of renewable energy in the United States, while also operating Florida Power. And Light, one of the country's best-run utilities, Southern Company, which serves the Southeast with a mix of nuclear, natural gas, and renewable generation. Duke Energy, which has extensive regulated operations across the Southeast and Midwest. Utilities typically pay dividends of 3 to 4%, which is attractive compared to bond yields. And because their earnings grow as they invest in new infrastructure, those dividends tend to increase over time.
During the inflationary 1970s, utilities were one of the few sectors that performed decently because they could pass costs through to customers via regulated rate increases.
I think we're facing a similar environment of elevated inflation and economic uncertainty, which makes utilities more attractive. The risks with utilities are manageable. Regulatory risk is real. If regulators become hostile and don't allow adequate returns, utilities suffer. But most state utility commissions understand that they need healthy utilities to maintain reliable power systems. They'll generally allow fair returns. Interest rate risk is also a factor. Utilities carry significant debt, so when interest rates rise, their financing costs increase, but they can typically pass those costs through to customers. And as long as you're not paying crazy valuations, utilities bought at reasonable price-to-earnings ratios of 14 to 18 times earnings should deliver solid total returns through 2027. The third sector I'm focusing on is consumer staples, and this is where I've spent most of my career. Consumer staples are products people buy repeatedly regardless of economic conditions. Food, beverages, household products, personal care items. When the economy is booming, people buy Coca-Cola and Tide detergent. When the economy is in recession, people still buy Coca-Cola and Tide detergent. The stability of demand is incredibly valuable, especially as we enter what I believe will be a more volatile economic period. But consumer staples is a large sector, and not all companies within it are equally attractive. The key is identifying companies with true competitive advantages, what I call moats. Brand power is the most important moat in consumer staples. Companies with brands that consumers trust and prefer can charge premium prices and maintain pricing power even when input costs rise. Coca-Cola can raise prices and people keep buying because they want Coca-Cola specifically, not just any soft drink. Procter & Gamble can raise prices on Tide because consumers believe Tide works better than generic detergent. At Berkshire, we've owned Coca-Cola since 1988. It's been one of our best investments ever, not because the stock price went up dramatically in any given year, but because it's been a steady compounder of value for decades. Coca-Cola sells its products in over 200 countries. It has one of the world's most valuable brands, and it operates a capital-light business model. Coca-Cola doesn't bottle and distribute its own products in most markets. It sells concentrate to bottling partners who handle the capital-intensive parts of the business. This allows Coca-Cola to generate very high returns on invested capital. We also own significant positions in companies like Kraft Heinz, which owns dozens of iconic food brands. While Kraft Heinz has faced challenges in recent years as consumer preferences shifted and we overpaid in the original acquisition, the underlying brands still have value and the company generates substantial cash flow. I'm also interested in other consumer staples companies. Procter & Gamble owns brands like Tide, Pampers, Gillette, Crest, covering multiple categories of household goods. Colgate-Palmolive is another quality company with global reach and strong brands in oral care and personal care. The beauty of consumer staples is the combination of stability and pricing power. In an inflationary environment, which I expect will persist, companies that can raise prices without losing customers are incredibly valuable. Most consumer staples companies have demonstrated this ability repeatedly. They faced commodity cost inflation in the early 2000s and passed it through. They faced it again in 2021 and 2022 and passed it through. Consumers grumbled but kept buying. Consumer staples also tend to pay reliable and growing dividends. Procter & Gamble has paid dividends for over 130 years and increased them for 67 consecutive years. Coca-Cola has increased its dividend for 61 consecutive years. These are dividend aristocrats, companies with such stable businesses that they can commit to raising dividends every single year regardless of economic conditions. For investors seeking income and stability, this is enormously valuable. Now let me address why I'm avoiding other sectors through 2027. Technology is the obvious question. Warren, You own Apple. You've made billions on Apple. Why aren't you focusing on technology? And the answer is valuation. Apple is a phenomenal business, which is why I bought it and still hold a large position. But at current valuations, with the Magnificent Seven trading at extreme multiples, with AI hype driving speculation in anything related to artificial intelligence, the risk-reward in technology has deteriorated significantly. I'm not saying technology companies will collapse. I'm saying the potential returns from current prices don't justify the risks. If I buy a stock at 40 times earnings and it grows earnings 20% for 3 years, I haven't made much money if the multiple compresses to 25 times earnings. The math doesn't work when starting valuations are extreme. Financials are interesting in some respects. Banks benefit from higher interest rates because their net interest margins expand. But the banking sector faces significant challenges. Regional banks have huge unrealized losses on securities and loans they made when rates were near zero. Commercial real estate exposure is a ticking time bomb. Credit quality is likely to deteriorate as the economy slows. And banking is a highly leveraged business where small misjudgments can lead to catastrophic losses. I'm more comfortable owning banks when they're trading at deep discounts to book value after a crisis has washed out bad loans. At current valuations, the risk-reward doesn't appeal to me. Real estate investment trusts are facing secular headwinds. Office REITs are in structural decline due to remote work. Retail REITs are challenged by e-commerce. Even residential REITs face questions about affordability and potential price corrections. I'm not interested in fighting these trends. There are better places to invest. Healthcare always has some attractive companies, and I own some healthcare exposure through positions in companies like Da Vinci, which we acquired. But the sector faces political risk around drug pricing, insurance reimbursement rates, and potential changes to the healthcare system. I'm not comfortable making large bets when political risk is elevated and unpredictable. So I come back to energy, utilities, and consumer staples. These are the sectors that pass my tests. They provide essential goods and services. They have structural advantages or competitive moats. Valuations are reasonable, in some cases cheap. The risks are manageable. And the political and regulatory environments, while never perfect, are relatively stable and predictable. Let me give you a practical portfolio construction framework based on this sector focus. If I were building a portfolio today for the next 3 years through 2027, I'd allocate roughly 40% to energy, 30% to utilities, and 30% to consumer staples. Within energy, I'd split between large integrated companies like Chevron and Occidental, independent producers like ConocoPhillips, and infrastructure companies like Enterprise Products Partners. That diversifies across different business models while keeping the overall exposure to energy fundamentals. Within utilities, I'd own a mix of pure utilities like NextEra and Southern Company, and also consider Berkshire Hathaway itself, which has huge utility operations plus other diversified businesses. Within consumer staples, I'd focus on companies with strong brands and pricing power: Coca-Cola, Procter & Gamble, Colgate, maybe some food companies like Mondelez or General Mills. I'd avoid the more challenged packaged food companies and focus on businesses with true consumer loyalty. This portfolio wouldn't be exciting. It wouldn't have the sex appeal of artificial intelligence stocks or cryptocurrency or whatever the latest hot trend is. But it would have several key attributes. First, it would generate significant dividend income, probably in the range of 4 to 5% annually. That's income you can live on or reinvest. Second, it would have downside protection. If the economy weakens and the market corrects, these sectors will fall less than technology and other cyclical sectors. Third, it would have inflation protection. All three sectors can pass rising costs through to customers via higher prices. And fourth, it would have upside potential if my thesis about energy supply constraints and utility demand growth proves correct. The worst case scenario with this portfolio is probably that you earn your dividends plus modest capital appreciation, delivering total returns of 7 to 10% annually. Not spectacular, but solid. The best case is that energy prices rise more than expected, utility demand growth accelerates with electrification,
and consumer staples maintain their pricing power,
delivering total returns of 12 to 15% annually. That's a reasonable range of outcomes. And importantly, the downside is limited. Compare that to a portfolio heavily weighted in technology stocks at current valuations. The best case might be 15 to 20% returns if the AI boom continues and multiples don't compress. But the worst case is a 30 to 50% decline if growth disappoints or multiples revert to historical norms. The asymmetry is unfavorable. The potential upside doesn't justify the downside risk. I've always believed that investing is not about hitting home runs. It's about avoiding strikeouts while consistently getting on base. If you can compound at 8 to 10% annually for decades, you become wealthy. But most investors can't achieve that because they take excessive risks chasing higher returns, strike out a few times, and destroy their capital. By focusing on these three sectors through 2027, I'm trying to maximize the probability of getting on base while minimizing the risk of striking out. There's one more reason I'm comfortable with this focus, and it relates to where we are in the economic cycle. We've had one of the longest expansions in history. Asset prices are elevated almost everywhere. Interest rates, while higher than they were, are still not at restrictive levels historically. Fiscal policy is extremely loose with huge deficits. The economy is showing mixed signals, with consumers stretched, commercial real estate troubled, but corporate earnings still solid. This is a late cycle environment, and in late cycles, you want to own businesses that are less cyclical, that generate cash regardless of economic conditions, and that trade at reasonable valuations. Energy, utilities, and consumer staples fit that description. Energy is actually somewhat counter-cyclical in that supply constraints tend to push prices up even if demand softens slightly. Utilities are completely non-cyclical. Consumer staples are minimally cyclical. If we do enter a recession in 2025 or 2026, which I think is likely at some point, these sectors will hold up much better than cyclical sectors. And when we come out the other side, they'll still be generating cash and paying dividends, while investors in more speculative sectors will be licking their wounds and trying to recover from major losses. I want to emphasize that this is not a forever strategy. I'm specifically saying these are the sectors I'd focus on through 2027. 3 years after that, the landscape will likely have changed. Maybe we'll have had a recession and market correction, creating opportunities in other sectors at attractive prices. Maybe energy supply will have caught up with demand, changing the dynamics there. Maybe new technologies will have matured to the point where valuations are reasonable. I don't know. But I do know that today, looking at the landscape as it currently exists, these are the three sectors that offer the best risk reward for the next 3 years. For individual investors trying to implement this approach, the easiest path is through low-cost index funds or ETFs that track these sectors. There are energy sector ETFs, utility sector ETFs, and consumer staples ETFs from providers like Vanguard, State Street, and BlackRock. You can build a diversified portfolio across these three sectors with just 3 funds, keeping costs extremely low. If you want to pick individual stocks within these sectors, that's fine too, but make sure you understand the businesses and are paying reasonable valuations. The discipline required is to resist the temptation to chase whatever's hot. When technology stocks are soaring and everyone is getting rich on AI stocks and your boring energy and utility portfolio is plodding along with modest gains, you'll be tempted to abandon the strategy. Don't. When consumer staples are underperforming and everyone is telling you that these old brands are dead and you should be buying direct-to-consumer disruptors, don't listen. Stick with the strategy. Give it the full 3 years through 2027. I've been investing since 1941. I bought my first stock at age 11. I've seen dozens of market cycles, countless hot sectors and industries that were supposed to change everything, and I've watched most of them flame out while boring. Steady businesses kept compounding. The lesson I've learned over and over is that successful investing is not about finding the next big thing. It's about identifying businesses that will still be around in profitable decades from now, buying them at reasonable prices, and having the patience to let them compound. Energy companies will still be producing oil and gas in 2030 and beyond. Utilities will still be delivering electricity. Consumer staples companies will still be selling Coca-Cola and Tide detergent. These are not going away. And that predictability, that stability is incredibly valuable in an uncertain world. So there you have it. The only three sectors I'd invest significant capital in through 2027: energy, utilities, and consumer staples. Not exciting, not cutting edge, not what you'll read about in most financial media, but based on 75 years of investing experience, based on understanding what makes businesses successful over time, based on careful analysis of valuations and risks and opportunities, these are the sectors where I believe capital will be best deployed over the next 3 years. If you have the discipline to follow this approach, if you can resist the siren song of speculation and stay focused on businesses that matter, I think you'll be very pleased with your results when we reach 2027. And more importantly, you'll have avoided the major losses that I believe are coming in more speculative areas of the market. That's not a guarantee. Nothing in investing is guaranteed. But it's the best strategy I know given what I see today.